There's a tremendous amount of worry in the markets right now. And I think the greatest source of the worry comes from what's happening in bonds. So I wanted to show you a couple of the bonds charts right here at the beginning of the webinar. So I have this specific way I've been counting bonds to the downside. Now, this is basically the opposite of like the ZB contract or the TLT. This is TNX, which is yields. Just a general way to chart what's happening with interest rates, basically. And this, I don't have as much data. On the ZB contract, I've got data going back to 1980. So I've got a tremendous amount of data, which gives some additional perspective, especially in Elliott Wave. But I would imagine that a lot of Elliotticians are calling this move to the upside since March of 2020 in yields a 5-wave impulse. Now, I'll show you some problems with doing that, and it's the thing that's kept me from counting a 5-wave impulse to the downside in the CB contract, the ZN contract, and TLT. But and on first glance on this monthly chart, you wouldn't even really notice that the initial move up off that March of 2020 low screamed way all the way up here, bounced from here all the way up here. And so that would either have to be ignored by an Elliottician if they're going to count 5 non-overlapping waves up, or they're going to have to count it like this: 1, and then wave 2, a wave 3, and then you have the problem of the wave 4 here. If you put it here, you have an obvious overlap. Now, in the blue book, Prector's blue book, he talks about how it states unequivocally that wave 4 cannot move at any time into the price territory of wave 1 if it's going to be a non-overlapping 5-wave impulse. Since then, some Elliotticians, including Jeffrey Kennedy, who's worked for Elliott Wave International for a very long time and does commodities, has stated that that it's okay if it overlaps into the price territory of wave 1 as long as the wave 4 doesn't end in the price territory of wave 1. And so if a person were going to force a 5-wave impulse count on this, they would have to call this a running flat or possibly a triangle, and then the 5th wave up. And then you have a third problem, and that is if you're going to set a Fibonacci target where wave 5 of the impulse was equal to the net traveled of 1 through 3, and I don't think there's any debating where the top of wave 3 is. It's right here. The debate is, where do you mark that target? So if wave 5 is going to be equal to the net travel to 1 through 3 times 0.618, where do you put that target? Well, I have found in my experience that you put that target at the bottom tick within the wave 4. So if you have a triangle, you don't necessarily put it at the end of the triangle. You put it at the end of the wave A within the triangle. And when you do that, you get a Fibonacci target that hasn't been hit yet, but it's getting within a whisker of hitting it. And I need to turn off a video self. Okay, there we go. So that target is at 2834 on TNX, and I'm going to move into a daily chart and talk a little bit more about this. So that target is at this blue line right here, and the bonds ended the week at 2713. So getting very, very close and screaming toward, I believe, that target. Also notice that target on this semilog chart, weekly chart, is very, very close to this descending trend line connecting the extremes of 2 and 4. So what does this say? Well, if this is a 5-wave up impulse, it's very likely wave 5 is very near completion. And that the next thing it would do, based on Elliott wave, is it would reverse and move back to the wave 4 of one lesser extreme, somewhere in that area right there, which, by the way, in this case would be, if the top tick was in, it would be, a little around a 0.382 retrace. Greg says, could the top of blue one be falsely overextended because of COVID? And obviously it was extended by probably the huge announcement of money printing coming out at that time. But that doesn't change the fact that as an Elliottician, I have to respect what, where these prices go. And why is wave 1 in blue not at the extreme low? And maybe you're speaking of wave 4 there, William. I'm not sure I really get, what you're saying there. So, I'll just represent to you that wave 1 right there happened after the bottom tick. That's why I'm late. You can see it a little better now. It happened after the bottom tick. So there's what would be labeled as wave 1, and then an ABC pattern for wave 2. Then you have your wave 3. And then the question becomes, are we going to go ahead and call this the end of wave 4 here? And if so, is this maybe a diagonal? And I've already measured everything. And if it's a diagonal, it would have to be an expanding diagonal. 3 is longer than 1, 5 is already longer than 3, so that works out fine. But the problem is that in an expanding diagonal, wave 4 must be longer than 2, and it wasn't. And therefore, if a person is going to force a 5-wave non-overlapping or any kind of 5-wave count on this, I think you have to put the wave 4 either here or here. Why would it be there? Because that would be a possible triangle there, although this little new high here above this high, I think really hurts that interpretation. That would be a more normal looking triangle, but it did make a little new high here above here. So I think it's best to label it, if you're going to label it, as a non-overlapping 5-wave structure to the upside. You put the wave 4 here and you call this an A, B, C, or a W, X, Y in the shape of a triangle. And then you'd be off and races to the upside. If this was a running flat, then or I'm sorry, in the shape of a running flat. I just said in the shape of a triangle. That's wrong. So it'd be a W, X, and then this is obviously an A, B, C here. If you're going to label this at the end of wave 4 here, and it would be a double zigzag in the shape of a running flat. And then 1, 2, 3, 4, 5. And within that 5th wave up, 1, 2, 3, 4, 5. So it's rough. And if you're going to force that onto it, I think you have to label it this way. And when you do label it that way, then you can draw this Fibonacci target for the end of wave 5, and we're within a whisker of hitting that, and we're also within a whisker of hitting this down, this basically trend line that is running across the peaks over the recent years. It's a down slanting. So that usually would present also some resistance. So I thought you might like to look at that as and consider the ramifications of what this is saying. And that is what this is saying to me is we're probably very, very near the end of this run on higher rates. And the next thing to expect would be at least a move back into the, to the way forward one lesser degree. If I take my Hurst analysis on the ZB contract and apply it to this item, we could go all the way into 2024 on this retrace. It's just that it wouldn't be nearly as large as what my wave count calls for when we look at the ZB contract, which would be kind of a mirror image of this. So, and so what are the implications of that then? What if rates quit going up? Yes, Ron, excellent. Here on this daily, or this is a weekly chart. We have a huge weekly divergence, but we do have the RSI up in. So I've been thinking about this, thinking that this, they've only raised a quarter of a point, and yeah, they're probably going to keep raising, probably a quarter point time. They're well behind the curve, and what the Fed really does is they typically, on average, will adjust the interest rates that they set, the overnight interest rate for banks, whatever, to what the natural market does, but it was about on average, about a 7-month lag. Well, they've been avoiding raising too early because they knew it would damage the stock market. And they, for a long time, while this was underway, were under the opinion that this inflation was going to be transitory. And so for that, we're going to go to another chart, the TIPS chart, and see what it's suggesting as far as, is inflation transitory, or are we going to see several more years or several more quarters of inflation? But anyway, what this is telling me is this move is way overdone. It's like they priced in all of the Fed projected quarter point raises over the next 6-7 meetings. It's already all priced in. And what would keep the Fed from raising that many times in a row? Well, I think what would keep the Fed from raising that many times in a row, well, there's a couple of reasons. One is if interest rates get too high, the U.S. government would not be able to even service its debt load. It probably can't now, but it's just going to make it impossible. And then the other aspect is that if we start seeing some downward movement here, then I think they're going to be less pushy about this schedule of raising 6-7 times in a row. But my take on this, as far as what can I do with this information, is that I think that the NASDAQ has been, I think, held down by the fear of interest rates just shooting through the roof. And I don't think they're going to. I think they're going to stop going up rather imminently. And I think that during this period here, we're going to see the NASDAQ do very well. Okay, so that's my take from that. And then on TIPS, this is super interesting. I don't know if anybody's been watching what's been happening with TIPS lately, but look, this uptrend, which really started back in November of 2018, where there was a grand expectation among the smart money that we were going to see quite a bit of inflation, and they were positioning that way, starting at this low back in November of 2018. And really, the COVID panic was just really a blip on the radar. And it disturbed this uptrend for just a little minute, as they say, and then it just pretty much kept trending higher. But at this point right here, and that was right around the end of last year, it broke that trend line. And this is not just a blip on a radar. This is a fairly serious dip moving down. And these down legs look like they're fives. 1, 2, 3, 4, 5. That one certainly does. And so it looks like the smart money is not as convinced, certainly, that inflation is just going to continue on. And this trend line has clearly been broken very convincingly, and then it came back to the broken trend line, found resistance there, and then it's been working lower. So this suggests that it's possible that this mega inflationary period that really started back in November of 2018 may have ended around year end. So isn't that interesting? So two of the big fears in the market are, number one, inflation, and number two, interest rates. And I just showed you a couple of charts that kind of suggest that we're seeing some evidence already, but if we see interest rates peak and start heading down, I think the stock market is going to go up.